Welcome back. Well, the markets are down a little bit in the last few minutes. We're down close to around 50, 60 points odd. But let's focus on the auto financial space now. The pain in the first half of the year was elevated for the sector. Is the situation improving the second half of the year? Will dispersal see a pickup in the second half? Is asset quality improving? Well, to understand all this, we are joined by the president as well as the CFO at Cholamandalam Investment, Mr. Selvan, who joins us on the show. Hi, sir. Good morning and thanks a lot for joining in. Well, tell us, what is your feedback? Second half of the year shaping up better? Are you seeing some kind of, a return in terms of growth rate? And a quick comment on asset quality as well. How much of pain is there in the system?
Yeah, we're seeing some return in, both demand as well as improvement in asset quality. I'll focus first on vehicle finance, which still is our largest part of our portfolio. In the vehicle finance, while CV's growth is still a bit muted, we are seeing some traction in heavy commercial, especially in the segments we are working with in the small road transport operator segment. And our used vehicles as well as passenger cars and MUVs are showing reasonably good growth. Tractor is picking up. While we are not seeing that much traction on the CE as well as on the mini LCV types. So it's a mixed bag, but we see the rural coming back with the tractor and some amount of PVs picking up in the rural and the light commercial and the heavy commercial vehicle. Okay. With regard to LAP, we are seeing good growth there, and with regard to affordable housing, we are seeing good growth.
Okay, all right. But tell us, is there a perceived slowdown in business momentum? Could you tell us what is hurting? Is it inflation that's hurting? Is it higher interest rates that's hurting? Because various pockets, the feedback you get is there is some kind of a slowdown. Are you experiencing that? If yes, which segment and what's the root cause?
Yes, in the as I was saying, in the CV segment, we still have not seen the full comeback which we expected to happen in the third quarter. While October was a good month, November sort of mellowed down, but we are expecting December volumes to pick up, especially with the calendar year coming to a closure and the model changes that would come into play. So we are seeing a reasonable growth. It will be certainly a growth over last year's same quarter as well as Q2 of this year, but it may not be a large growth that might have been initially thought about.
Right, Mr. Selvan, good morning. Prashant here. Yeah. Sorry, just to pinpoint on commercial vehicle side, sir, could you give us some sense what has growth been like and what do you expect for the full year?
So the vehicle finance overall, it will clock a growth in the range of around 12 to 15% on the disbursement, and on the asset side, it should be in the range of around 15 to 20%. This is what we are seeing as we move into Q3, Q4, because these two quarters last year has been fairly good, but still we'll be better than last year. It may not show a significant good growth. Our used vehicle traction is good, and we are seeing passenger vehicle also growing in a reasonably good shape. But we still have to see the growth coming in the heavy commercial and the light commercial vehicles.
And those growth rates which you mentioned for Q3 and Q4, you think it's a bit lower as compared to what you imagined you would be at when you started the year?
It would be more or less similar from a vehicle finance perspective because we had factored in that these would be a little slower growth. See, what is happening is we are able to manage the similar level of growth because we have the product diversification. So whatever we are seeing as a slowdown in the new commercial vehicles, we are able to manage it with the help of used as well as the increase in the passenger cars. Two-wheelers have sort of stabilized. It is not growing aggressively. It is sort of keeping at the same pace as what we have done in the first two quarters.
You're not dependent on one segment, and I think you kind of managed to sort of press the pedal on other segments when growth somewhere else slows down. So overall growth guidance remains same, 25%?
Yes. Overall, company as a whole, including way of lab and other products put together, we still see the growth at the 25% number. I know it was being pushed to 28, but I think we should keep it at the lower end of the 25 to 28 forward statement we had discussed earlier. We should still clock 25 plus.
Okay, all right, Mr. Selvan, what about the new business? As a proportion of your total mix, how do you see that improving, and what will be the ideal contribution to your total business going ahead? If you could give us a time frame as well as contribution percentage.
So the new businesses will continue to be less than the 15% number which we had been, in the first half of this year. The mortgage businesses, which is the LAP and HL, will be the one which will see growth at the cost of a slight proportionate reduction in the vehicle finance. So you will see vehicle finance coming to around 54-55%, and then the mortgage businesses growing to around 32-33%, and the balance coming in from the new businesses. The unsecured will remain at the 8 or 9% level, and there will be growth in the SBPL and the SME segment to make up the balance 100%.
Okay, all right. Mr. Selvan, final question before we let you go. Give us a comment on the net interest margins. How do you see that shaping up? The RBI in all probability will start cutting rates from early 2025. So how do you see your NIM shape up from here on? And also quick comment in asset quality. I recall in the Q2, the provisions had spiked up, and you'd explain that to us as well. But could you comment on both these two, NIMs and asset quality?
The NIMs will marginally improve. We are not factoring in any rate reduction by RBI, at least for this financial year. If at all it happens in February, the impact of that would be marginal to the extent of only 1 or 2 months at best. So we are not factoring in, but we are seeing some amount of benefit because a lot of our borrowings have been benchmarked with the T-bills and money market linked instruments. So that has given us some improvement whenever there have been fluctuations in these instruments. So NIMs will improve with also the increase in the marginal yield as well as the book yield of vehicle finance, which we, as you recall, we have been talking about the mix to change as it moves into as the old book, which was dispersed during the COVID period, runs down, and the new book with a higher yield becomes a larger part of the book in vehicle finance. With regard to asset quality, yes, we did see some increase in Q1, Q2. You will see some drop in Q3 and more in Q4. This again we had iterated when we spoke earlier.
Mr. Selvan, we'll leave it there, sir. Thank you very much for joining us. It's a pleasure speaking to you, as always, and getting a sense of what the rest of the year perhaps is going to shape up like. Some numbers there from Mr. Selvan at Chola Finance as well.